everybody. Welcome. Thanks for joining us. We're talking to our favorite partner economist, Dr. Elliot Eisenberg. We'll be talking about the 3 keys to unlocking the 2024 market. And I'm here alongside my colleague, Tom, to discuss different questions, subscriber questions with the good doctor here. How are you doing, Tom?
I'm doing great, and I'm so happy that it's Dr. E Day, as we call it.
Yes, it
Thank
is.
you.
How are you doing, Elliot? How's it going? We're excited about this recording.
Thank you. So am I. Every time, it's always a lovely time. It's always a blast. It's always fun.
Excellent. Well, we're hoping to keep this one short. We're seeing that people are really responding to our shorter, segmented type sessions, but we have a lot of good, exciting stuff coming up. A little bit of a different format since this is recorded, so we're gonna definitely get your 3 keys. We cannot forget that. In fact, we'll start off there. But also, we're gonna ask some questions. It came partly from our subscriber, partly from our team. We're gonna do a fun yes or no segment, which we have not done before, and then we're ending with a Mythbuster. So this should be a lot of fun. We're going to try to keep it moving, try to keep it light. But Dr. Eisenberg, if you could start off, what are the 3 main things you have to know about 2024 to properly navigate the market?
A takeoff on the location thing about real estate. I think 24 is rates. We've seen the January numbers just came out, and they were pretty good because interest rates fell in November and December, and that's what was driving January sales, obviously. Since then, rates have gone up. They'll get a little worse. And rates, we were hoping that rates were going to come down a little faster. And Powell reminded us that he's not going to lower rates as quickly as we think. And a month ago, the markets thought there'd be 6 quarter-point cuts, maybe even 7. And in rapid succession, it went to 6.54, and now it's down to about 3.5. So we're going to have higher rates for a little bit longer. Rates aren't going to come down until probably sometime around June or July, Fed meeting, as opposed to the optimistic March belief. This is probably the 4th or 5th time in the last several years that the markets had to adjust to what Powell was saying. Markets didn't believe Powell. Now they do. And now we're upset, disappointed, and we're unhappy, petulant children, and interest rates go up and the market suffers. So rates are the most important thing to follow in 24. We've become much more sensitized to rates. When they were 3 or 3.5, we didn't care. But when they're 7 or 7.5, wow, we really care. So that's the first thing. Maybe it's the first and second or first, second, and third. The other important thing is inventory. Look, there's no inventory. And inventory numbers came out just recently. NAR came out with their numbers for January, and wow, they went up. They went up from 990,000 to 1,010,000, an increase of 20,000, utterly meaningless. There is no inventory. So this is, I think, 24 really is shaping up to be a transition year. That's an elegant way of saying kind of tough. But rates are a little too high, inventory is a little too small, and yeah, we're going to sell more homes than we sold in the last 4, 5, 6 months of 23 when rates were on their way to 8%. Sure. And that's a good thing. But this is not going to be 23 or 20. This is not going to be 22 or 21. In 21, we sold 6 million units. In 22, we sold 5 million units. And in 23, we sold 4 million units. That's a decline of 33%. I mean, real estate's really gotten hit. So that's the second thing. The third thing is we may have a recession and we may not, but it doesn't matter to the real estate community. And I think that's very important to point out. Look, we've already gone from, as I just mentioned, 6 million to 4 million sales nationally, a decline of 33%. It's not going to get worse. You look historically speaking, you never get below 4 million for any length of time. There can be a weird thing, 94, 95, whatever, but COVID hit 4 million. The worst of the housing bust, 3.8 million. I mean, 4 million is baseline sales activity generated by people, estates selling homes of people who've died or passed away, divorce, death, debt, whatever, these things that force a sale. So that's the baseline level, and that's what we're going to be at here pretty much. We don't get below that. So this year will be better on the real estate market side, even because whether we have a recession or not really is important. It's not important. Don't think about that if you're a realtor. It may matter to your buyers and sellers a little bit, but rates will come down either way, and 24 will end up being better than 23, recession or not. How's that?
I love those.
Rates,
Yeah.
inventory, and recession, who cares?
And
Interesting.
so when you say it's a transition year, really we're at the worst point of the year, and it should get better from here on out. Is that a more optimistic way of saying it?
That's a fair way of saying it. Yeah, rates
Yeah.
fall later half of the year. Inflation, we're convinced inflation's really closer to 2. I mean, there's an outside chance inflation picks up, the Fed doesn't lower rates. I mean, don't sell your child on this here, don't bet your thumb on this. But the expectation is inflation does fall, and keeping rates at this high level for a long enough time will do the trick eventually. Hopefully it doesn't get us into recession, but either way, rates will come down. They'll come down faster if there's a recession, obviously. And the recession won't be that bad for real estate because there's pent-up demand, rates will fall enough, unemployment won't rise that much. That's why I'm really not concerned about the impact of a recession on the housing market. Because you're way ahead of the market, the economy. If the economy goes in recession, you're already in a recession in the real estate market. So yeah, I think you're right. Real estate prices, rates come down second half, things improve.
Tom was looking for a positive there, and then it got
Yeah.
but that leads us to our first question. So as we were summarizing, either things that we didn't get to cover in the last one, or just questions we've gotten from subscribers. The unemployment was a bright spot. So the last time we talked to you, you were talking about unemployment being kind of a bright spot in terms of looking toward 2024, and then you said unemployment numbers, and that was all very positive news. But then in the Bay Area, we've had a lot of layoffs, and so I was wondering if you have you changed your mind since then, or has anything changed on that topic that we would think of going forward?
Meaningfully, no. Yeah, there's tons of these layoffs taking place. All these big name firms have laid off 1,000 here, 2,000 there, whatever it is. But there's also a tremendous amount of growth. I mean, look, AI is going to help San Francisco and the entire metro area, right? Moving down to Silicon Valley through Atherton and Los Gatos and so on, is going to help. There's a tremendous number of employment growth, seed capital money going in there, venture capital money going in. Don't just look at the layoffs in isolation. Yeah, they're not great news, but that's a small sector of the economy, and AI is big for Silicon Valley.
Interesting. I was noting because we Acculist just recently, well, we have San Francisco data, and I was noting that last year, every single month, Santa Clara County and San Mateo County had a higher median price point than San Francisco at every point last year, which I would not have seen or expected several years ago. And so it's really interesting there. But when you say San Francisco, you really mean it, because it's clearly enhanced the value of properties all along the Silicon Valley, peninsula corridor.
Right. Yeah. From San Francisco up north down to San Jose, further south, and all the way in between. But this AI is the real deal. We can argue how much impact it has on GDP down the road, and employment and unemployment, yeah, whatever. But this burst of enthusiasm and investment eagerness is a big deal. So there's layoffs, but the overall data doesn't show any meaningful rise in unemployment. It's pretty strong. It's a key part. And if this number stays strong, we avoid the recession. If unemployment starts to tick up, I'm more concerned. Part of me is concerned, but I think in Silicon Valley, I'm a little less, because you've been through some of that already, and now AI is here to help.
Interesting. So Tom, you're an avid follower of Dr. Eisenberg, and you were noting on his one of his recent entries from last week, I believe, and you were talking about
It's just Monday.
Labor productivity. So
yeah, profound productivity. And so I wanted to ask you, Elliot, about, because the way I read the blog entry, you were saying, well, this isn't the productivity isn't happening in sectors prone to productivity improvements. And so there's job redesign and some. So I just was wondering if you could talk about that, because I was fascinated.
I think you just answered all the question. I'm done. I'll call you Dr. Tom and we're done. But you're absolutely right. What we've seen, it's very strange. We've seen labor productivity growth the best in 10 years or 11 years, since 12 or 13 or 11, whatever it is, way back when. So we believe the data is accurately collected. So assume it's correct. But then we also know that the most the biggest growth in employment over the last couple of years have been in two or three sectors that show notoriously weak labor productivity growth. K through 12 education, not much going on there. A movie, maybe high tech, not much going on there. Healthcare, notoriously inefficient, right? Leisure hospitality, what's that, massages and hotels, not much there either. So what's going on? And it's exactly what you said. Unemployment's relatively low. Wage growth is relatively intense. California, for example, has increased minimum wage, and other states have, and fast food franchises in California, and so on. So firms are redesigning jobs. The other thing is construction activity. Construction is starting to show, for the first time in maybe 5 decades. I mean, I'm not joking. There's been dismal productivity declines actually in there. And that's good news too. So whether it continues or not remains to be seen, but if you get labor productivity growth, that's the silver bullet. It's magic, because right now wage growth is about 4%. Historically, wage growth has been about 3% minus 1% labor productivity growth gets you to 2% inflation, essentially. If we get labor productivity growth to 2%, that means we can withstand 4% wage growth, which is what we have, because 4 minus 2 is still 2, and that's inflation. So this would allow us to keep wage growth pretty intense without having to induce higher levels of unemployment to get wage growth down. We could keep it higher, and the labor productivity does the dirty work for us. So it's a free lunch. Let's just cross our fingers it happens, but it's very good. And the fact that it's happening despite the increases in employment in low productivity sectors is major. Now, AI comes around and it begins to boost labor productivity. It's early in the game to show that yet. It's too early. But maybe next year, the year after, we begin to see real labor productivity growth. That would be even better, or not better, more.
That's really interesting. And it's a reminder, right, to subscribe to your blog, because that was one where Tom was like, we've got to talk about this. And so, the bowtie 2282
66866. Text bowtie
6866.
66866. And you'll be prompted.
So glad.
One word, bowtie.
Bowtie, all one word, 66866. So one of the things you mentioned in the opening, you said the most important things, and then we skipped right over it, but interest rates. And so one of the questions we had, just to follow up on our last session, you were thinking June, and you're still, you introduced that at the beginning of the program. So you still believe June, and you're very confident in June, a June decrease, or?
I would say June. Yeah, I'm still betting on June. There was an optimism of March and May. I never jumped on that bandwagon in my blogs, as you saw. I never said that. I always kept saying June. I'm still saying June. Maybe it's a 10% reduction in June probability from 90 to 80 or 80 to 70. And July is now from 10 to 20 or something. But I'd stick with June.
I love that. We got him to it's like the odds.
Yeah.
I've thrown a dart and I've said June. You'll tell me
what would change it?
4 months.
What would change your opinion, Dr. Eisenberg?
So the Fed is really focused on inflation. So they're beginning to ignore unemployment. They're really focused on inflation. So if the inflation numbers come out hot, that would be the killjoy. I'm not sure they're doing the right thing. We can argue, but that's besides the point. But they're telling us inflation's their guiding star, their North Star. If those turn out hot, CPI, PCE, PPI, whatever the numbers, whatever inflation metric they look at is too hot, they'll just delay. So the fear is between now and then we have a couple hot CPI inflation numbers and they delay till July. Could happen.
Okay, that's great.
Late. They're willing to be late. They don't want to be early. They don't want to lower and then raise. They prefer to wait and lower with certainty.
So that's something to look forward to in terms of what information comes out could really affect our sales cycle, the extension of the sales cycle, when we see a lot of volume come on the market type thing later this year.
Interest rates are important. They matter. They really do. The buyers and sellers, especially the buyers.
You know, Elliot, we got a lot of consumer confidence questions, and I say that they came in the form of a couple of things. One was, you had talked about post-COVID consumer spending had been, rampant. Now we were really cutting back. And so we just wanted to get your thoughts on that. Because, there's some like consumer sentiment aspects of not feeling like this is a good time to list your home or buy a home versus the actual data was suggesting prices really held in most of our counties. And we saw a pretty strong end of the year. And so those two things seem related to me, but maybe you can comment on the post-COVID consumer spending and how that's slowing or if it's slowing. And as far as their feelings towards selling and buying this year.
Consumer confidence has been very uninspiring over the last couple of years. Small business sentiment also hasn't been good. That having been said, consumers continue to spend their brains out. So I'm not convinced that historically economists like to look at sentiment because it kind of gives you a mood, and the mood helps you figure out what spending will be. But of late, that hasn't been the case. I think the major reason here, and I've done some digging like all economists have, I'm not the only one looking at this, but I get the feeling that politics has polluted some of this data. And that, when Trump's in the White House, Republicans are happy. When Biden's in the White House, Democrats are happy, and so on and so forth. So the politics has gotten into the data, and it's changed people's moods. I'm not convinced, the data doesn't show that it's changed people's spending patterns, but it's changed their attitudes, their general sentiment. So I look at the consumer sentiment data a little bit more skeptically than I have in the past. It's not that it's unimportant. I think it's important, but less valuable because of this external impacts that are being had, where the occupant of the White House becomes much more important than it was in past years because of the divisiveness of politics in the US in general. It's a manifestation in this data.
So you're saying that our decline in spending on goods and services and really coming out post-COVID and going, we have some cash to spend and we're going to go out and do all the travel and things that we couldn't do during COVID. So you're saying that doesn't necessarily correlate to, first of all, it's not as big of a deal when it comes to purchasing a home, and it's
Right.
maybe polluted by politics anyway. So in both cases,
Correct.
because the anecdote we hear is my clients are waiting, right? My clients don't know if this is a great time. My clients want to know if this is a good time. And so that's the form that it comes in as we're out talking to our subscribers and our brokers. And so I'm just trying to make that into a question that has to do with the economy, right?
Well, there are a couple of things here. One, look, if you're an investor and you're buying 5 houses, right? Okay, then you can afford to wait, you can afford to look, you can afford to be much more. But if you're living your life, and I've said this before, I'm generally of the notion of get on with your life and buy the house or sell the house and continue doing whatever it is you want to do. Because you can wait 2 or 3 years and rates don't behave like we think. And you've sat there, waited 3 years, and now you're 3 years older and you've got nothing to show for it. So, you're living in a house, you're buying it for your family or whatever. Get on with it and just buy the house. You can always refi down to a lower rate in 6 months or a year or 2 years. So take advantage. In 6 months or a year, maybe rates come down and there's this huge demand for housing. There's more supply, but there's much more demand as well. It may not be easier to buy a house then. What you should be doing now is looking to buy your house. Find the neighborhood you want, find your price point you want, and be prepared to pounce when the house comes on the market and get it. And then know that you're going to refi in 2 years and save, a percentage point on your interest rate, maybe more.
So that's really interesting.
Consumer sentiment. I don't think it's as helpful as it was 5, 6, 7 years ago.
That's super interesting. We get asked a lot if we could kind of infuse consumer sentiment in with our data, which we can't. We're the MLS, and so anything that's required, that's what we have access to. And so I'm always like, no, I can't. But that's a good, point to share with people as they're talking to their clients.
The consumer sentiment is put up by 2 different places. The University of Michigan puts out a consumer sentiment survey every 2 weeks. It comes out. End of month is the full month, and mid-month they call it the mid month, but the final is the real one. I think the Conference Board puts them out, and there's been some variation of the two. The two aren't exactly moving together either. So there's some, and the questions they ask on both sides are a little bit different. That explains some of the difference. One's more labor force, and one's more purchasing of things, but they are getting better. But they're not as valuable, I think, as they used to be.
That's interesting. One of the things that we've been trying to do for our subscribers, Elliot, is highlight national trends and, like closed sales, very low closed sales, the, lowest number of closed sales in Santa Clara, San Mateo, and Santa Cruz County, right, Tom? Since 2002, since we have really accurate,
Yeah.
clean records. Shout out to engineering out there. And then, for Monterey and San Benito, there was a 2008 or something. There was, it's
Right.
not quite as long for those South counties. They had some years with fewer. So definitely following national trend there. But one of the things we've been out talking to people about, Tom and I were noting that cold feet, the concept of cold feet in the Bay Area. We looked at TFTs withdrawn, canceled for both single family and common interest, and we just don't see it as much. It was year over year, very negative, very down, particularly in voluminous Santa Clara County, a little bit higher in Santa Cruz. But, we just didn't have that national narrative. We're seeing insurance troubles, Elliot. We see some problems securing funding, particularly with like HOAs on the common interest portion. But, we wanted to reassure our subscribers that's one way where nationally we differ a lot from some of our the national markets or the summation of national markets. Any thoughts on that?
You really are a very different market. And I can't stress enough. I gave a speech last week in Aspen, Colorado. And I said to them, look, you're very different than the rest of the economy. You're a little piece of Manhattan, high-priced, multifamily, in the middle of nowhere, Colorado, I mean, the ski hills and so on. It's beautiful, whatever. You are too. Look, IPOs matter to you. The stock market matters to you. A lot of weird things that don't matter almost anywhere else matter to you, like they matter to Aspen and Jackson Hole, Wyoming, and whatever. So the stock market improving is a big deal for you as well. The stock market being on a run now for the last 3 or 4 months or whatever it is, since October, November, whenever it was. This NVIDIA doing so well, the Magnificent Seven, maybe it's down now the Fabulous Five, but whatever. Their performance, them being tech companies located in many cases in Silicon Valley, and the stock market doing well, and IPOs doing a little bit better, that's all going to help your market a tremendous amount down the road, and AI. So yeah, don't look to Fort Wayne and Pittsburgh to get inspiration of what's going on in Silicon Valley.
Yeah, we always caution people about the headlines because your buyers and your clients are reading them, and they're person at work. We never want to give our colleagues faulty information, but we do, and we have anecdotal things that may not be right. And anyway, we're always trying to go out there with some data and some compelling information for having those good conversations with your clients. And so that was one of the ones where we thought we would bring it up to you because we just don't see it in our data.
I mean, if you want to play devil's advocate, you could say, look, the stock market's a little highly priced. These 5 or 6 magnificent companies have relatively high price to earnings ratios, and it's their PE ratios, NVIDIA aside, it's the PE ratios that are really driving the stock prices, and that makes me a little nervous. You look at the bond market, and the bond market really has changed their perspective based on Powell and the number of rate hikes this year expected. The stock market really hasn't adjusted to that. So could you argue the stock market's overpriced and we're due for a correction? Yeah, I wouldn't be upset with that. I mean, I wouldn't be happy as an owner of stock, right? But the economist in me says, yeah, it's a distinct possibility. So that might be something to consider in the back of your mind. If the stock market has a 10% or 15% correction, that wouldn't be great.
Excellent.
Sorry.
Tom, I think we got through our subscriber questions pretty well there in terms of, things that have been coming up lately.
Yeah.
And so I don't know if I missed any, Tom, or if we should move on to yes or no.
Let's go to yes or no. I think this is the rapid fire round, I guess.
Yeah.
We haven't prepared for
the
this.
lightning
I don't know what
round.
you're going to say.
No, you don't. And it's fun because we got some of these from our subscribers. Some of them come from our staff. We try to have a little fun with it. But the idea is that you can say yes or no, and you can add a little bit, but we're looking for that's what makes it difficult. And that's what makes it fun. So we're going to start.
I agree.
Here. Okay, so this one.
Oh, okay. You're going to start and then I'll.
Or go ahead. You know what, Tom? People are probably tired of hearing me talking. You go ahead. Nice change.
All right. First question. Will we ever see 3% rates again in the next decade?
No.
Okay.
He loves this game and he's so good at it. All right, Tom, keep going.
All right. Do you think the Bay Area real estate market will fare better than the rest of the country in 2024?
I'll say yes.
Okay.
Yes, I think it will. The the AI thing is serious. There's lots of money there that will overwhelm any other negative things, I think.
Okay.
Yes.
Should I keep going?
Sure. He's
All
doing a
right.
great job. I love this game.
So, Generation Z, we
How
read
old are
that
they?
they're never going to be able to afford a home. Is that real
Oh,
or
no,
fear
no,
mongering?
no.
Okay.
They're buying homes. They're buying homes later in life. We're seeing every generation buy homes a little later. So the great generation that fought in World War II came back, bought a home at 24 or whatever it was. Now marriage is occurring later. Childbirth, average age of women with a child is getting later. College, student loans, and so on keeps pushing it off. So they'll get there a little bit later. So it may take them until 34, 35 versus 32 for you and 30 for our grandparents and 28 for our grandparents. But no,
Yep.
don't buy houses.
That comes
Okay.
from a colleague, so she'll be happy to hear that. She said, or is it just fear mongering? And I said, I'm going to throw that one in for you. One of the articles in Inman recently was that date the rate, the concept was deceiving and potentially very bad advice. How do you feel about that?
So I have to answer that. I know what I want to say. I'm not sure if that's a yes or a no. I'll say no.
Go
Because
ahead.
it's wrong advice. I think it's a reasonable thing. I think marrying the house and dating the rate's reasonable. Look, there's no guarantees in life, and maybe rates don't come down. That's possible, but you're going to have to qualify with the current rate that you're buying the house. You can't say, "Well, I expect rates to fall, and then let me qualify to 6% when the rate's 7.5." They're going to force you to qualify now. So if rates fall, all the better. Would I put a pretty high probability on being able to lower the rate down the road a year from now? I would. I would. So I think that it's a fair thing to do. Rates are unusually high. Moreover, there will be a recession at some point. Whether there's a recession soon or in 3 years or 4 years, you can refinance then too. So this isn't a window of refinancing that closes forever. It may take longer to get the chance to refi, but there'll be a chance at some point.
So can I just clarify? So date the rate means adjustable rate mortgages get an adjustable rate versus a fixed rate. Is that what date the rate means? I don't.
At least in my mind, date the rate means you can get a variable, but you can also get a fixed rate at this, and then down the road marry a low rate.
I see. Just plan on refinancing. Date
It's
the
a
rate means
Plan on
plan
refinancing.
on.
The Inman article was heading that direction and saying, because it is unknown and we don't know, well, we suspect that that is a possibility. That's why we're asking our friend here.
Look,
Yeah.
I don't know about tomorrow's weather. I could get hit by a car. I could fall into an elevator shaft or a manhole. The fact that we don't know the future should not stop you from doing lots of things. This is one of the things it should not stop you from doing.
Yeah.
Just live with the consequences, but be prepared. Buy the house prepared to pay 7%, if you will, but have a reasonable expectation that 6 is plausible. Don't think 4, but think 100 basis points, 1 percentage point decline is fair to think about.
And yes or no kind of fell apart on that one, but I think it's a good question, Tom, to make sure that we have this. Okay, back to yes or no. Does the stock market favor any one of the presidential candidates? Is there like a difference between someone who's being elected other than someone else, trying not to be political?
Wow, geez, I don't know. I'm walking through I'm thinking it through right now and saying Biden. First of all, the data shows you cannot plan your portfolio investments based on who's in the White House. That's a failed strategy. So I'm not a financial analyst. I haven't passed my Series 7, Series 9, Series 66, Series 437, Series 9,837,316. So don't sue me. But the data clearly shows that the returns are not higher for Republicans or higher. They're actually higher when Democrats are in the office because recessions seem to occur when Republicans are in the White House. This is not because they're Republican. It just is because just bad luck, right? There's no big deal here. But the data says there's no relationship. You may think there is, but it doesn't turn out that way.
Ooh, good
Don't
one.
change the strategy. The overarching thing is don't change your strategy based on the expectation of who will win the White House or who actually won the White House. So come November 7th or 8th and you know who won. There may be a boom in the stock market that day or a bust, but that's not a long-term thing. Don't trade on that in the long run. Daily, sure, whatever, right? may have a day holding before the election, like that morning of Tuesday versus Tuesday night, maybe you can make some money. But in the long run, no.
We'll all call in sick that day, right? And take PTO and be timing the
I'm going to
market.
say on that one, who does it benefit? It benefits nobody.
Oh, all right. That's a good one. You answered a couple of our yes or no. So the last one, will there be more sales in the Bay Area in 2024 than there were in 2023?
Yeah, I think there will be. I think the rates will come down a little bit, and that will encourage people to get off the sidelines who are sort of holding. I mean, look, people have a tenure in their house of 8, 9 years now. It's gone up a little bit because you're older and so on. But people have to move, and this keeping your low mortgage, the cost of keeping that mortgage is staying in your house. But people have children, they get married, they get divorced, they want to move to a different place. The kids have moved out, the kids have moved back. You got to move. So when rates fall enough and the gap between their current mortgage interest rate and the new rate falls low enough, as it continues to fall, people will start to put their houses on the market. And rates will generally likely fall. So that should increase sales activity. Yeah.
That's great news for our subscribers. They'll be happy to hear that.
And look, don't think of it. It's not going to be like 21 again. Don't think that, but will it be better than 23? The answer is yes.
Nice. I think you did a really great job on yes or no. I think this is a keeper. We'll have to ask for feedback, but we're trying to do some new segments and keep things fresh. So our last new segment and last question is a myth buster. And so, we are out talking to agents all the time, Elliot, and we get asked a lot, is it best, considering the Bay Area, and it's diverse, so I hope I didn't set you up here, but is it best to use average or median price when considering Bay Area real estate?
I'd still stick with median. I would. And the reason is the same, even for the Bay Area, maybe even more so. But, price, you want to get the general notion of what's going on in the middle of the distribution. And the only way to get that is to look at the median. You might want to say, I want to look at the standard deviation or the variance as well, but that gets a little complicated, right? People don't remember their college statistics class anymore. Average can be affected by one or two very expensive houses at the very upper end. So I live in Miami. Jeff Bezos just bought a house that cost $100 million. That's going to move the average price by a couple $1,000 probably for that quarter, right? Yeah. Won't move the median at all. If you're a high-end realtor, you may want to look a little at the average price. If you're specializing in homes over $2 million or $3 million, so you're kind of ignoring the bottom 3 quarters, and you're only focusing on rich people living in Pebble Beach. I'm making it up, but you get the idea, right? Yeah. Fancy places with beautiful views and whatever on a golf course, whatever. That may not be part of our geographic location. If it's not, my apologies.
No, it is. It is Monterey County.
Pebble Beach. So, okay, if you're specializing in Pebble Beach, there the average matters and you ignore the median. But if you're selling in a general area of a number of homes in San Mateo, like, get the median price in San Mateo's. Unless you're selling only, I don't know San Mateo that well, but I'm imagining that San Mateo closer to the bridge is more expensive than further away from the bridge. That may or may not be true. I don't know the data well enough, right? But my point is you're closer to San Francisco, your commute's a little lower. I'm making it up. Yeah. But generally median is the thing to look at. If you're selling homes to the normal people who are spending in your area, in San Mateo, like $1.5 million or something like that, right? $1.3 million or something. Yeah, the median is the right place to go.
Interesting. For us, a lot of times too, it's comps. So if everything gets entered in a 0 or, like especially with DOM and things, then it can really affect an average. But, we're just, that gets posed to us a lot. So I guess it wasn't phrased in a myth buster. It should have been, is average better than median? I guess I'm not that good at, I'm not good at this.
Don't think of better or worse. Don't think of it.
Different.
It's both useful, but the median's a little bit more useful. Again, if you're a realtor specializing in the middle of the market, if you're really going upscale, then you also want to know the average. Because you might say, look, the median didn't change, but the average is up 10% because there's some very expensive homes that are selling and they're going up in price, so there's more sales in that area. That's another question. Why is the average going up? Is it going up because prices are higher or because more expensive homes that are more expensive are selling? you got to get that out there as well.
Nice. So what you're saying is know your data, and that's what Acclaimed does. So thank you for leading me into a plug for our data. We do have new what we call web widgets, constantly updating charts and graphs that are available only to our subscribers. You have to be logged in to see them, and there's 10 years worth of data by city, by zip code, by county, and there's an average, median, price, and average and median price. So whoever
Good.
wants to see all of those, and yeah, so we're really trying to bring our subscribers a
one to
lot of
look at-
data.
The other one to look at is, days on market's also a useful metric to look at. There's all kinds of data out there. Don't be shy. Get familiar with other pieces of data. If the price goes up and it takes an extra like 6 months to sell the house, we know that the more expensive the house, all else equal, the longer it takes to sell the house. That's pretty well understood. So keep that in mind too. There's a lot, when you go see a doctor, the doctor doesn't just take your pulse. They look up your nose, they look in your ears, they look at your temperature, they draw some blood. And from that, they're trying to get an understanding. Similarly, the data that you're providing gives people hopefully a holistic idea of what's going on. Don't look at one data point as the data point. There's no the data point.
Awesome. Well, I think that's a good ending piece. I mean,
Yeah.
I want to point everybody toward your blog again. We love having you, and everybody's been really looking forward to your thoughts on what we can expect. At least for the time being, you'll be back again in about 90 days or so. So we're going to keep you coming in, and it's bowtie, all one word, 66866. Did I do that right this time?
And
Yes.
you'll be prompted for an email address. You'll put it in. You'll hear from me every day.
Hear from you every day, but it's short. People
70
getting
words
used
or
to
less.
me. I'm wordy. I'm a little bit prolix there, but you're not on this blog, and
On the
so
blog,
it's
I'm not.
very entertaining, very fun blog. Bowtie, all one word, 66866, and we'll look forward to seeing you again. But thanks for being a trooper on Yes or No and Mythbusters. We want to get this out to our subscribers as fast as possible, so we'll be getting this recording out, and we'll see you in another couple of months.
Thank you both. Thank you,
Sounds
Michelle.
great.
Thank you, Tom. A real pleasure.
All right,
you.
take care.
All right. Bye.
Make sure to check out our Pro Support page for additional videos on a full range of topics. And don't forget to click that subscribe button on our MLS Listings YouTube page.